Hello, everyone. Welcome back to the Retire While You Work podcast. Miles Zuger here, joined by Carson Onum, another advisor on the team, and Jerry Ann Agee, our director of operations. Going to be kicking off April here with some info on Financial Literacy Month. So it is Financial Literacy Month, if you didn't know that. And we're just going to go over some topics, maybe some of them basics, maybe some of them not so basic, but just for those listeners who are just trying to get a better understanding of maybe starting out on their financial journey or wanting to understand the difference between some topics that are good foundational topics. We wanted to shed some light on that. And speaking of light, if you're watching the video version of this, I do have some better lighting in my office, which we got some complaints here about. Thanks to Carson for buying me a good light in here.
Next up, maybe you'll upgrade your headphones and quit having wires dangling from your ears. But
I know, I saw that.
I just
too.
like them. I just like the wired. I don't know what it is.
I was gonna say real quick on this before we get started that we've all been in this industry for a long time. So all of these stocks, bonds, ETFs, whatever, mutual funds, that's like common for us just to talk about every day, or just we know what that is. But when you just talk to a regular person on the street, they don't know what a stock is, a mutual fund, anything. They don't have a clue. And especially with like young investors when they're starting out and they're even putting money in their 401ks, they don't really know what they're investing in. So this is a good topic, I think.
I spoke to some kids on a Saturday, like a few weeks ago, and one of them, he was probably like, I think he was maybe like, I don't know, 16, 17, 18, somewhere in there. And he was asking me like, hey, should I be investing in mutual funds or index funds? And I was like, oh, wow. Like, I mean, not some adults don't know that. And I was like, you're 16, 17 years old and you know that. I was pretty impressed, but I think he had obviously, and they were talking about like Roth IRAs and stuff. It was just funny to hear younger, I mean, they're adults, but like younger adults talking about that. It was cool to see that they were interested in it too.
Yeah, that's great.
I mean, that's initially how I got started in the industry. I knew this is what I wanted to do long term after a very base level financial planning class I had in high school, and I had a fantastic teacher, and that kind of is what stirred up my passion for personal finance. And through college, really, for me, it was I would just get online and I would research stuff. I would watch YouTube videos. I know it's pretty lame, but I would watch YouTube videos, read blogs, just to learn about financial planning, to learn about the differences of mutual funds and ETFs. So that's where I was going for my sort of information. But if you don't have that interest, society and education systems aren't designed to teach you that in order to get you ready to do that. So that's why we have the Retire While You Work podcast, to do just that.
That's right. Which is, yeah, we've kind of alluded to it, but yeah, the first thing we're going to be talking about for this series is just the difference in stocks, mutual funds, bond, index funds, and kind of just some quick notes on maybe what they all are and maybe how they can fit into your plan when you're thinking about, should I be using a stock or a bond or a mutual fund or an index fund, which index funds also known as ETFs. So, Carson, maybe we can just, or one of you can kick off here, just, maybe just quick descriptions of each of them and kind of what they are.
Sure. Let's just kind of kick off with stocks, just because that can kind of lead into the mutual fund, ETF, and bond conversation. But stocks overall, if you think about the stock of a company, like let's take one of the most commonly known companies out there, Apple. Let's think about Apple and a stock. If you want to buy their stock, essentially stock is true ownership of a company. You're buying one share. When you hear that Apple's trading at $150 a share or whatever like that, whatever it's trading at, you're buying one share of the company for $150. Now, as an owner of the company, if you buy a share of their stock, you are truly an owner of the company. And the reason that you can look up their stock price and see what the price is because it's what's known as publicly traded. I can sit here, I can go on into an exchange, and I can sell my one share of Apple stock. Somebody out there is going to be on the other side, and they're willing to pay for it. So then that's where it's an exchange. That's where we get price movement. So then I'm trying to sell it for 150. Somebody out there doesn't want to buy it, but for 140. So then there's the middle ground. Maybe then that determines a share price of 145 in that scenario where each person's willing to go to trade that. And a stock price is driven on what do you think the value of the company is going to be in the future. If you think Apple stock is going to be $250 because they're going to grow their earnings and they're going to continue selling iPhones or making new technology, so on and so forth, then you'll buy it at $150 a share because you know it's going to be worth more down the road. And you want to be on the receiving end of that and grow your money because you think the stock price is going to grow. you are truly buying a share, an ownership in the company by buying stock in a specific company. Now, that is not without saying that, yes, you do own a portion of the company, but that's where it's also risky. I know Apple is, a use case where it's one of the biggest companies in the entire world. But what if you buy a small company and their technology doesn't come out well? Well, its share price could fall 60% because all of a sudden their technology is not going to work anymore. That's where you get the phrase, don't put all your eggs in one basket. Don't take all your money, invest it in one stock of one company, because then if something specific happens to that company, that can really have a detrimental impact to your financial plan. But
I mean,
what I'm
would you say don't put all your money into just stocks?
I think some of that maybe depends on just kind of how old you are and what stage of life you're in. Do you need some of the money in the short term, or are you truly viewing this as all of the longer term money? Obviously, if it's longer term money, that's where you want to be investing more in stocks. And to kind of maybe continue on what Carson was saying there, it's like, okay, if you don't want to put all your money in just one stock, and maybe you don't even want to be the one picking the stocks, what are your options? And that's where mutual funds come into play. So when using mutual funds, you're essentially going out, and there's thousands of different managers out there, but to keep it simple, you're hiring a manager essentially who's going in and picking a basket of stocks. So rather than just owning one individual stock, you're owning a fund that owns 10, 50, maybe 100 more companies. So you're then diversifying your risk out by owning hundreds of companies by just owning one mutual fund in a way to, again, try and grow your money. And you're usually buying a certain sector of the market. So maybe you're buying all large cap companies, which would be Apple, Amazon, Google, Facebook, companies like that. Or you're buying maybe a basket of small companies, which is small cap stocks, which are more riskier. And that's maybe where you don't want to put all your money into one of those. So you're buying a basket of 50 of those inside of a mutual fund. And you're paying that manager some sort of nominal fee to run that portfolio for you. And for that, he should be justifying his fee. So he should be making more than what he's charging for the fee, essentially.
I was going to say a mutual fund is what's known as active. So like you said, you're paying a manager to pick and choose these stocks. So that manager is not just going to buy and sell or buy stocks and then let it sit there for the next 10 years and not do anything. There would be no management there. It's active in that he or she is buying stocks and selling them when they think they need to, and then buying new stocks. So there's going to be what's called turnover, meaning they're buying and selling stocks and turning the portfolio over and buying new names and selling some of the old names that they had based on how they think that they can outperform the index that they benchmark themselves to. So you're investing in, again, like a large cap arena, and you're paying that manager to attempt to outperform the large cap index by turning stocks, buying and selling, which is different compared to there's also index funds. So that's mutual funds. You're buying a manager. They're trying to outperform their underlying index. Then you can buy ETFs or index funds. And essentially what this is the opposite of active. This is what's also known as passive investing. An ETF is essentially trying to mimic an index. So one of the most common indices, whichever out there, is the S&P 500, some of the 500 largest U.S. companies. And there's an S&P 500 index fund out there. Some of the most popular, SPY, IVV, VOO, whichever, they're all trying to essentially mimic the S&P 500. So there's not going to be, yes, there's people who manage this index fund, but they're not actively buying and selling differently than the index. They are truly trying to match the index exactly. And what you're going to get is index performance. So if the market's down 50%, you're going to be down 50%. But if the market's up 30, you're going to be up 30 or very, very close to it, as opposed to an active manager who's picking and choosing differently than their index because they think they know better than the index. In a year where the market's up 20, you could be up 30. Or when the market's down 30, you could be down 40, or you could only be down 20, depending on how their performance does.
So are they still using that same index, the mutual funds and the ETFs, but one is just wants to stay more in line with the S&P 500 and the other one is trying to outdo it?
Essentially, yeah.
Okay.
And I was going to say, yeah, with the index funds, the benefit is they can be a little bit, one of the big benefits is that because there's less trading happening. So if you're buying and selling and you're selling for more than you bought those stocks for, there's obviously taxes you have to pay. With the manager, the mutual fund manager, you don't pay taxes or know how much you're going to pay till the end of the year. With the ETF or the index fund, it's similar, but because they're just trying to mimic the index, there's not a whole lot of trading that's going on in that given year, which means in theory they should be much more tax efficient because there's less buying and selling going on. So that's one of the biggest, I think, benefits of the index funds, or that's why most people use them, was because of the tax efficiency that they can have.
Mm-hmm. But the benefit of both, at the end of the day, if I've got, making something up, if I've got $1,000 and I want to go buy some Apple stock, what's Apple trading at? $220 a share, and I've only got $1,000. I can only buy like 4 shares of Apple stock. That's worth $880, and I'm only invested in one company. So what you can do is you can buy an index fund or a mutual fund, and like an S&P 500 index fund, you could buy a couple shares of that, and all of a sudden your $1,000 is now diversified across 500 of the biggest U.S. companies out there. So it's a quick, it's a relatively easy way to get broad diversification through an index fund or a mutual fund without having to have the capital to go out and buy all these shares yourself. You're essentially letting a manager do that, and they're giving you the diversification. So that's what the big benefit of ETFs and mutual funds is diversification with a very, very small amount of money. Now, all that to say, I think individual stocks can still have their place in a portfolio. It's not a bad thing. I think it really takes more capital in order to get to that point, so that our rule of thumb is never let an individual stock holding be more than 5% or so of your investable assets. So if you've got $100,000 invested, try not to let one name be more than about $5,000 or so of that portfolio. Again, it's just to lessen your risk. That way, if that one company goes under, has a really bad performance in a given year, it's not going to wreck you. Like, even if that one company is down 50%, okay, well, now your 100 grand is only down to.
I mean, I think a lot of people think of the stock market as just strictly stocks, that you're just investing in stocks. They don't realize there's these other options. Like my son, his grandfather set up an UPMA for him a couple of years ago, and they're big into picking a stock, and I was like, no, let's pick a couple, and then let's go with like Growth Fund of America and something boring that's a mutual fund that's going to perform well. And he was like so bored with that, but then he saw, like, when his returns, he was like, oh, that's not that bad. It's better than my stocks were doing.
Yeah. And I think, I mean, it can be hard to pick individual stocks, or as we've talked about, if they're doing bad, like if you own one stock and it's down, like you're going to be down. Whereas if you're diversified across hundreds of companies, half of them could be down and you could still be positive for the year. And I think that's one way though, that's easy to get kids in. Like, I know we talk about that with some clients' kids, is it's like, to get them interested in investing, you may have them buy like Nike or like Apple, companies that they're, because maybe they have an iPhone or they like wearing Nike shoes. And it's a way to like get them interested in investing by saying, hey, you're actually an owner of this company. And it can just be cool to them and get them a little more interested in it. But then if, like, to your point with your son, Jerry, and it's like, well, then those stocks weren't doing so hot. So maybe he would have been just better off in index for a mutual fund.
But that's a learning experience. I mean, that's like a firsthand learning experience that by being overly weighted towards one company, it can kind of suck. Like, yeah, you hear the stories about Nvidia, how it's up 900% over a couple years. Okay, well, yeah, that's only the good stories. But on the other end of that, there's all the failure stories. Like Nvidia now, over the past 6 months, it's down 9% over 6 months. I mean, that's a long time to have performance not very good. Yes, that's, you go over a 5-year period and start to zoom out a little bit, it's had an amazing run. But what a great way to learn about the stock market, by buying the stock of a company that you like, you use, you buy the products, see how it performs, and and that could potentially just increase the importance of diversification at a very, very young age. But you mentioned how, there's, on the other side of that, on this podcast, we frequently talk about asset allocation and stocks and bonds. So on the opposite side of that, of stocks, maybe not the opposite, but a different type of investment, there's also a bond. Just as a quick skinny of what a bond is and how it's different from a stock is, let's use the same example of a company like Apple. A company like Apple what they can do is they can issue a bond. And what a bond is it is someone loaning a company money and getting interest on as payment for loaning that company money. So for example, Apple needs $100,000 to go and, apply towards a factory they're doing to make iPhones, whatever. So they'll issue a bond for $100,000. I buy that bond. So I'm giving Apple $100,000 for them to go work on this manufacturing. And they give me a stated interest rate and a stated term. So over 5 years, they're going to pay me 5% a year. So Apple's thinking, okay, I can get $100,000 now, and I can just have to pay this investor 5%, $5,000 a year for the next 5 years. And then at the end of the bond term, 5 years later, I just got to give him their money back. He gets his $100,000 back. That is essentially what a bond is. History shows that there's not as much volatility as stocks prices. Bonds can move. I can go halfway through that. I can go sell it to somebody because there's a price attached to that bond. If they're looking for 2.5 years left on my bond that's paying 5% interest, or I can hold it to maturity. And essentially what you're doing is you're just clipping your interest. That is by, you're giving a company that money. You just get your interest. If you're retired, hey, this is great. I've got mailbox money coming in. It's what I can spend, on a monthly basis. And at the end, I still have my principal. That's essentially what a bond is. Now, there's probably dozens, if not hundreds, different types of bonds out there. There's government as well, but it's essentially interest on a loan.
Yep, and I think the biggest reason. Go ahead, Jerry.
Go ahead. No, I was just going to say the great thing about a bond too is it's not, your bonds are not in the stock market. So when you hear about the stock market going up and down, your bonds really aren't affected. So if the stock market is ever down, for instance, and you needed money, we always like to keep some bonds on hand so that you never have to sell a stock while they're down. Now the rate won't be necessarily as great as some mutual funds or stocks when the market's doing well, but it's still a solid rate, especially right now at 4 or 5%, 6% sometimes.
Mm-hmm.
Yeah. I mean, the goal with the bonds is to kind of all those points to be there as a source of liquidity should you need it, a little bit less risk than stocks, hopefully, and also maybe for somebody who's retired, clipping some good income for retirement income, just to be there in a little bit more stable way. Because again, stocks can be up and down kind of with what's going on in the news or what's going on with their company, and a lot more volatility there.
Mm-hmm. Yep. Income and diversification. So just even diversifying the portfolio and not just being all in on stocks. That's great. Yep. Yeah. There's an important part of all these pieces to a portfolio. I think every mutual funds, ETFs, stocks, bonds, they all have their spot in a portfolio. So they're all great ways to get invested and get diversified in the stock market. But hopefully, I think we kind of hit on the basics of some different types of investments.
Yeah, I think so. Yeah. I think, hopefully, if nothing else, we shed a little bit of light on kind of what each of them are, what some of the main differences are, and maybe where they fit into a financial plan. And if you have more questions, we're happy to answer them in an email or a phone call. So feel free to reach out to us. But thanks again for joining us on this week's episode of the Retire While You Work podcast. And again, going to be doing a little bit of a series here on some financial literacy with April being a financial literacy month. So if you have any topics you want to hear, feel free to send them over.
Sounds good. Well, thanks, everybody. We'll see you next week.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.